There are plenty of reasons to be concerned about your portfolio right now. In fact, some of you new to investing might flat out be scared, and all of these emotions are perfectly normal. It's not fun seeing a ton of red across your portfolio day in and day out. And there's a lot of reasons to be concerned, at least in the near term. There's tariffs, a slowing economy, a slowing labor market, geopolitical tensions, and much more. The negative factors far outweigh the positive factors right now. And if there's one thing that investors don't like, regardless of how long they've been investing, it's uncertainty. And there's a lot of uncertainty that surrounds the market right now. So right now is probably a good time to take a step back and look at the outlay of your portfolio. Are you well diversified? Do you have some defensive pockets for your portfolio? As such, in today's video, we're going to be talking about 3 ETFs that could save your portfolio, bring stability during these uncertain times, during these periods of volatility. But before we unveil them, do me a huge favor, show your appreciation by simply clicking that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video, take a look at 3 ETFs that could help stabilize your portfolio. Beginning with ETF number 1, which is going to be the iShares 20+ year Treasury Bond ETF, stock ticker TLT. I'm not someone that invests in bonds all that much, but right now, given the uncertainty, if you're looking for a spot to hide some cash, TLT could be a great option. Right now, the administration is putting through a slew of new trade policies, and these tariffs have brought some volatility to the market. The administration is hoping to level out the playing field. For a number of years, there has been tariffs on U.S. goods. Just look at autos, which have a 10% tariff. For years, the U.S. on European autos has only been a 2% tariffs. So we're trying to get back to an even playing field. And as the administration puts it, a period of reset. However, this reset or recalibration has brought a lot of volatility, and it's not fun going through. But at the same time, I'm going to be someone that's always looking to remain invested, whether that's more defensive assets or whether that's more on-risk assets. And right now, I think, is a great time to be a little bit more selective with your investments, which is again why TLT could be a great option. If you think about it, the more volatility ramps up, the more uncertainty that is around the markets, you're going to have investors that are going to be flooding to bonds. And when bond prices go up, yields come down, which I believe is really the ultimate goal for this administration right now. This country has a boatload or a mountain of debt. Right now, just looking at the total debt that we have, interest payments alone over a 12-month period are hovering around $1 trillion. That is not sustainable, and we are on the verge of going off a financial cliff if something isn't done. So, with the markets coming down, putting pressure on the Fed to do what? Lower interest rates, that would allow them to refinance all the debt we have right now, which could be a big step forward. Not going to solve everything, but definitely a big step forward. So, as yields come down, bond prices go up. Again, it's making a lot of sense to put some short-term money into TLT. With TLT right now, you can grab a 4% yield over the trailing 12 months, and there's potential share price appreciation because interest rates have an inverse relationship to the bond price. I like TLT below $90. ETF number 2 is going to be the Schwab US Dividend Equity ETF, stock ticker SCHD. This one should come as no surprise. As we saw with the first ETF we talked about, TLT is an income-focused ETF with bonds. SCHD is equity with a yield piece and share price appreciation. Many of you probably saw my recent video where SCHD went through its annual reconstitution, and it has a complete new look, one that I believe is going to work with the current market conditions. As you can see now from the sector breakdown, energy is the top sector, accounting for 21% of SCHD. Consumer staples accounts for 19%, healthcare 15%, industrials 10.5%, and technology is sitting just under 10% exposure. Those top three sectors, energy, consumer staples, and healthcare, all scream defensive. So if you're concerned about the current economic conditions in the near term, SCHD is a great spot. But at the same time, let's say the bottom is in and the market rebounds in a big way. By investing in SCHD, you're still going to participate in those. TLT, not so much. That one's more focused on fixed income. There is some share price appreciation as yields come down, bonds increase, but if the market is taking off, TLT is not going to participate in that. SCHD will participate in that. The top holdings after the annual reconstitution currently consist of ConocoPhillips and Chevron, two energy giants at the top, followed by Verizon Communications, Coca-Cola, Bristol-Myers, Altria Group, PepsiCo, Amgen, Cisco Systems, and AbbVie. In total, the ETF consists of 104 total positions, and the top 10 accounts for 40% of SCHD. Some quality stocks there in the top 10. I love the energy exposure, but as you know, SCHD can give that share price appreciation and a solid growing dividend. Right now, you get close to a 4% dividend yield, but you also get strong dividend growth, which is at a 5-year dividend growth rate of nearly 12% and 13 consecutive years of dividend growth. ETF number 3 on our list is going to be the Spider Gold Shares ETF, stock ticker GLD. As you can see here, I wanted to give you 3 completely different ETFs. With the bond ETF, that's focusing more on fixed income with some potential share price appreciation as the price of bonds increase. ETF number 2 with SCHD is equity focused with a solid dividend, one that grows at a strong clip. And then this third ETF is a commodity ETF, an area that investors for decades upon decades have fled to, especially during times of uncertainty. Over the past 12 months, GLD has trounced the performance of the S&P 500 to the point where GLD is up 40% versus the S&P 500 climbing just 7% now. Even more impressive, considering the past 2 years of 20% plus growth for the S&P 500, GLD has outperformed the S&P 500 the past 3 years to the point where GLD is up 60% versus the S&P 500 climbing 22%. Gold is a commodity. It's been a store of value for hundreds of years, especially when investors are faced with uncertainty. And over the past 12 months, we have seen record buying in terms of gold. Gold doesn't erode. Gold has lasting value. Gold is finite. It doesn't have to worry about beating analysts' expectations or giving strong guidance for its share price to increase. It has been a proven commodity for hundreds of years. So if you're worried about the economy, especially in the near term, even at record levels right now, gold could be a great spot to park some cash. So those are 3 different ETFs to focus on stabilizing your portfolio during this period of uncertain times. Again, there's plenty of reasons to be concerned about the economy, especially in the near term. But at the same time, this doesn't mean we need to sell out of everything. But if you're looking to put cash to work right now, be more selective. And if you're looking for some stable ETFs, these are 3 that we just went over right now. In the comment section down below, let me know which of these 3 ETFs would you most likely be investing in the near term. Or maybe you're already invested in. Let me know down there below. And if you haven't done so, make sure you smash that like button, subscribe to the channel, and we'll see you in the next one. Take care.